a skill above and beyond the risk-free rate of return and is using a skill to produce absolute returns. And then the other term that's used is beta, which is the correlation to the market. And if we assume that TSX is a benchmark for most Canadian hedge fund managers, then to say that beta equals 1 means that they are perfectly correlated with the TSX market. To say that it's less than 1 means a low correlation, and to say that it's greater than 1 means that the hedge fund is even more volatile than the TSX. Collectively, beta and alpha constitute about 70 to 80% of hedge fund returns. There are other factors like luck, for example, that would incorporate the rest. A lot of people have questions about how hedge funds get paid in terms of performance fees, and it's a little bit different from the traditional mutual funds and other traditional investments. The most typical fee structure for hedge funds is a 220 structure. They make 2% fixed rate on the net asset value, but they also earn a 20% performance fee on all profits generated by positive performance as well. And this is really what drives hedge funds and creates the incentive for hedge funds to outperform, are these performance fees. However, they are subject to something called the high water mark. So in this example here, if we have in this simplified example, we have the net asset value per share, which really is almost like a stock, which is how hedge funds trade. But let's say we brought the hedge fund from $3 to $6, and so $6 is the high mark. Performance fees will have been made all the way along from 2004 to 2006. However, this hedge fund has a particularly bad year in 2007 and drops to $4. Well, this hedge fund manager is going to earn 0 performance fees until they return back to this high water mark at $6. There are things to look out for, obviously, when you're purchasing hedge funds. Sometimes there are some hedge funds that have high water marks that reset, for example, and there's other provisions as well. So you need to be careful to look out for these things. But in most cases, hedge funds that are down significantly this year are not going to be earning performance fees until they get back to the high level that they were at previously. So a lot of hedge funds are not going to earn performance fees. To give you an idea of how significant these performance fees are, if we look at a $100 million hedge fund, for example, this $100 million hedge fund would earn $2 million on the 2%, which is the fixed rate. However, if this hedge fund returned 20% and made $20 million, we would take 20% of that, and the hedge fund would also take home an additional $4 million in performance fees. So the performance fees could be a significant component of how they are compensated. We're going to get now into some of the traditional hedge fund, the strategies that are deployed by hedge funds. Long-short equity is the most standard basic strategy. It represents about 90% of Canadian hedge funds. That the percentage is dropping. That we are seeing now a diversification of strategies in the market, but this is the most typical strategy. In this case, the manager uses a bottom-up approach in which they look at underlying stocks, they look at financials, and they assess whether stocks are undervalued or overvalued. If they're undervalued, they will buy those stocks. If they're overvalued, they will short sell those stocks. So this is the typical approach used by the hedge fund manager. To say that they have a long bias means that the fund has greater long exposure to the market rather than short. To say that the hedge fund has a short bias means that the hedge fund has more short exposure than long, meaning they feel that the market is going down more than it is going up. And finally, we have the concept of a market neutral, in which you may have a 50-50 balance of long and short positions between stocks. Most market neutral funds deploy leverage because obviously returns are going to be much smaller if you are hedged 50-50. They're considered beta neutral because they have 50% long and 50% short positions in the market, so there's small market risk. And one of the strategies that are deployed with market neutral funds is pairs trading. And I will give a perfect example. If I am a hedge fund and I wanted to make a couple trades in the auto sector, I may deem Toyota to be a strong company and GM to be a weak company. So I will go long and purchase Toyota, and I'll go short and short sell GM. Well, if we look at over the last year, that would have been a fantastic pairs trade because the money you would have made on the short sell of GM far outweighs the money that you lost on Toyota. So that is an example of one type of strategy in market neutral that gets deployed in order to make returns for investors that are conservative and will not have substantial gains or substantial losses theoretically. global macro is a strategy in which hedge fund managers look at opportunistic allocation of capital over a wide variety of strategies and asset classes in various geographies and sectors. Often, economists are hired into global macro funds, and they look at various countries, they look at sectors. So they take the top-down approach, and they pick the industries that they think are going to outperform. And then they invest globally into these various industries. So they'll have greater exposure to interest rates, exchange rates, and liquidity risk, and so forth. And they performed relatively well in 2008. And I also forgot to mention as well, with long-short equity funds, let me go back one. And for the long-short equity funds, the one thing I forgot to mention, this asset class did not perform particularly well in Canada over the last year because a lot of them were net long. But however, there are funds that did perform well. For example, with a fund that had a long bias that did well was J.C. Clark's Preservation Trust. It was up 20%. In terms of short bias and market neutral funds, SciVest had funds that did quite well. SciVest is up 13% with a short bias and up about 6% with their market neutral. So those are examples. With the global macro, an example I will throw out is the Friedberg Global Macro Fund that was up 40% in 2008. The next asset class that we're going to get into now is the managed futures. And just flipping slides here. The managed futures, they trade on the spot or the futures market globally, and they're referred to as commodity trading advisors. And they generally get exposure in currencies and commodities like gold, corn, and various other commodities as well. They have low correlation to traditional equities because they make plays on the actual commodities and currency rather than stocks. The most fund managers, they trade derivative contracts, and they take long and short positions on commodities. They tend to do well in areas of huge volatility, which is why they tend to outperform in this type of period. 2008, managed futures was the best performing asset class. Returns went anywhere from 20 to 40%. A couple examples: integrated asset management returned 40%, Auspice returned 44%. So as you can see, this is an asset class that has done very well in 2008. If there's perception that there's going to be continued volatility, this will be an asset class that will continue to outperform in 2009. And it is also a good diversification from equities. The last piece of the strategies I'm going to talk about is arbitrage. And really, the term arbitrage is the practice of sourcing temporary mispricing opportunities, making a quick trade, and profiting when the market's realigned to fair value. So I'm going to talk about 3 quick arbitrage strategies here. When it comes to convertible arbitrage, the most typical strategy is when you see a mispricing in convertible bonds. Convertible bonds are bonds that can be converted into equity or into shares of a company. And so what the hedge fund manager will typically do is purchase a convertible bond and short the stock of the same company, and they will invest the proceeds of the stock. So they get interest on the bond, they get interest from the proceeds of the short sale of the stock. And basically, if there's an adverse impact on the company, whatever you lose on the bond, basically you will make up for with the short sale of the stock. And if the stock were to go up, you can use the convertible bond and convert the shares to equity to cover your short position. Now let's go into merger arbitrage. With a merger arbitrage strategy, generally we know that when an acquisition takes place, the acquirer will either stay flat or go down upon the acquisition, but the acquiree will go up because generally when acquisitions are made, there's a premium or goodwill paid over the net book value of the company. And so in these situations here, the hedge fund managers will wait for an acquisition announcement. Once the acquisition announcement gets made, they will buy the acquirer and they will buy the acquiree, short sell the acquirer, and when the acquisition actually takes place, the hope is that the hedge fund manager will make money on the short sell and on the long position on the acquiree upon the announcement. Finally, there's fixed income arbitrage, and generally this is mispricing some securities with interest-bearing instruments like bonds. And a typical example here is the short sale of a low-yield bond like treasuries and going long on high-yield bonds like triple B corporates.